Good evening, everyone. Thank you very much for joining us. Oh no, I thought you were going to start talking
I
now.
was about to, and then I just saw you do your thing, and then I thought
Yep.
you're going to do something prolific.
Thank you for joining us. So tonight we've got a whole bunch of territory to cover. We're here to put a wrap on the options game, and but also go through. All right. So about trade flow, I'll let you talk about
Yeah,
that. It's
exactly.
your company.
Me being the other guy's got better sound anyway. So, okay. So TradeFloor, we're a fintech company. We ultimately try and push the boundaries with what we're doing in the financial services industry. Part of that is working with Pat. We'll quickly talk about that. TradeFloor runs risk for around about 70% of the retail derivatives flow now. So most of the clients that trade derivatives or on behalf of derivatives or derivatives on behalf of their clients ultimately use us for risk management systems. And ultimately, we've partnered with the ASX to go on and build the options trading game. So we partnered back, it's been, about 2 years now together with Richie Marcus, which is a company that Patrick runs. And ultimately, we came together with Implied Volatility, which is the same trading platform that is based on the options trading game, but it's real and allows you to have the exact same experience. And the idea is to really build a way for traders to easily be able to place orders of any kind of complexity into the market. It's all based on our real-time risk management system, and as we found out over the past, really got tested over the past 2-3 weeks of trading. Obviously, we're pretty proud of what we've done, I was doing some trading yesterday, right on the close, and it was I would have not been able to do what I did last night in any other system ultimately, which is great. And what we've done with everything, ultimately what we've done with everything is we built a platform based on our risk management systems, based on our technology. We've got the best rates in the country now. It allows you to trade combos straight through a platform, smarter analytics and all that kind of stuff, real-time pricing, and lots of education. So we run webcasts, we run all that kind of stuff quite frequently. So
Yeah, and I think from our perspective, so from our perspective, when we set up this, Ivan and I both came from the same perspective, and that is that as traders, we were never satisfied with the solutions that were being put in front of us. We either had on one side online brokers that weren't investing in technology, weren't really committed to the cause of options trading. And on the other side, you had full service stockbrokers, such as Charlie Sheen on the screen here. And we don't have anything against full service stockbroking, but it is very expensive. And again, I don't get technology. I don't get support. I'm just getting that execution advice where the guy sitting there holding that phone believes himself to be the font of all knowledge, but I'm a trader, got my own views, right? And so for us, we wanted to create the best technology that would allow you to do everything you needed to be able to do and keep investing in that technology to keep growing it. And then to be able to give you the support to be able to use it properly, educate you so you can expand your knowledge without having to go and spend $5,000 on a weekend trading course or anything like that. Just keep building the education and then go and look at, well, how do we go and get really smart people working with our technology, test our own hypotheses, trading hypotheses first, but then expand that so that we can then give you great trade ideas. So the why behind what we do really is to serve traders and to create a business that is just solely focused on trying to create the best environment for you to be able to trade effectively. And that is what we've embarked upon. You said 2 years. It hasn't actually been anywhere near that long, Ivan. We started about 16 months ago.
It's so far away from 2 years. It's 8 months short.
Yeah, well, that's it's, what is that, 30%? So, but
It's almost how much the market dropped yesterday.
But from us, what we've seen in probably in the last 6 months, in the last 6 months, we've definitely seen this. We've seen 20% growth month on month, every month to our trading business. We're on track. Oh, that's 5 months, but this month we're definitely on track for that. That's market related as opposed to the trend of people just coming on adopting our technology. And so we invested in it very heavily early on, but it's something that we're both very, very passionate about. We do other things outside of purely just derivatives trading. We have other businesses and interests, but it's been a real passion project for both Ivan and I.
The most
Yep.
important thing isn't so much even the growth
Mm,
in usability and all that kind of
mm,
stuff. It's the fact that most of our clients are actually profitable.
mm.
That's the most important part.
Yeah. Well, interesting looking at our P&L yesterday.
Mm.
I don't reckon many trading desks would have had a significant profit from
I'm
yesterday's
not
trading
revealing
activity.
anything
Yeah.
that I may know about the rest of the industry.
Yeah. But yeah. Anyway, so that a little bit about us, and I know a lot of people on the session tonight are people that we know the names of very well. But there is also a lot of people that are coming through the options trading game who haven't heard of us or worked with us before. And with the options trading game is a fantastic way to actually get in there and start trading. And we know that quite a lot of people will come back and play the game a couple of times before they'll actually even think about trading options. And we just think that's a wonderful thing because you shouldn't be in a rush. What you want to do is try and do it and do it properly. And if you can go into an environment like that, and you can practice and test trade, then that's wonderful. Now, anyone who's been through the game or anyone that's on the session tonight, if you want to get the ability to continue on, just type in a Y. I won't say yes because we've asked everyone to say yes 1,000 times already, so we've got a million yeses. Type in Y to indicate yes, and we'll organise a 30-day trial for you if you want to continue to have access to the technology you've had for the game. And what we'll do, David, why? Yep. And what we'll do is we'll give you access to that, and we'll also put another 50 grand fictitious dollars in your account so you can continue what you've been doing trading the game. And through this next period of time, it's going to be a very exciting period to trade, especially a good time, not necessarily to be risking your own money, but it'll be an exciting time to actually be in the market and trading. So if you want to continue on
And
learn, and we'll give you access to our trade ideas, the education portal, and all the other information. Anyway, enough from that. So we were technology. I think an interesting thing is Ivan and I got met as the education partner for the ASX, and Ivan was building the technology for the options trading game, therefore the technology partner. And we spent a lot of time on roadshows as guest speakers for the ASX, and thus a fair bit of time drinking wine after the end of the event, talking about the market. And one of the things that I picked up very early was the technology that Ivan had built was able to do things that as an options trader I'd never been able to get. I'd never been able to get tools that I could use that just worked. I always had to like mess around with an Excel spreadsheet, import data into it, work out dates, and then even then it was like very, very cumbersome and slow. And I know Ivan knows this. I spent $500,000 building my own options technology, which I ran, options calculator, ran for 3 years and retired hurt from that whole experience.
The simple solution is spend 5 million and nearly have trade floor.
Yeah. But the amazing thing is how little people have really adopted technology in the last decade or 2 decades. As everywhere else you look, technology has exploded and taken over.
And it's interesting, you look at, we're doing some stuff with unis at the moment as research projects, and it's really interesting that for a lot of people, they find trading very interesting. And so a lot of the education now, or a lot of the push from the PhDs and the postdoctorates that we're going to be working with is around specifically around options, because it's been something that for the first time now in the last 5 years or so, how relatively cheap computational power is now. It's possible to go in and do research that typically we wouldn't have been able to do. So I think options are a great space from that point of view. A lot of research is going to be done over the next decade globally, and we're glad that we're going to be sort of at the forefront of this here. A lot of this is driven by this slide that between 56 and 2015 has been a trillion-fold increase in performance. For those of you that have been on, I love this slide, and I'll just mention it again, that, the first real supercomputer was built in 1985, weighs 2.5 tons, 30 million bucks in today's money, sits in a museum, powered a lot of space missions outside of sort of just flying to the moon. And the previous version of the iPhone is 6 times more powerful than that machine. It has enough power to land 240 million rockets on the moon simultaneously, or at least the Apollo 11. So it goes to show just how much technology has advanced, the stuff that we've got in our pocket now. And ultimately, we use that to go on and build quant ideas, and we'll talk about that at the end. But it allowed us to go on and build a bunch of hypotheses, put it into a quant-based algorithm designed by quants on the back of our hypotheses. And then it actually, because we've got a defined period, the actual algorithm can learn from itself and it adapts as the market starts changing. We haven't had a lot of adaptions since we've sort of started. We've got the performance we've updated now sort of from April last year, I think. No, April this year we launched. Sorry, April last year we launched. So it's almost been a year now, and it's been very definitive. So anyway, so we'll talk about that. So one of our trading systems, the breakout system, has had great success. We've been trading this throughout. Finished first in June 2018, second in December, third in July, third in December, and this time around, I actually thought we finished third. Turns out we actually finished first. So we'll talk about what the trading system entails. We did leverage it, just like everybody else does in the game, to make it fair, but it goes to show quite how powerful and consistent it's been throughout this period. But at the moment, let's start talking about the winners. And before we do that, do you want to do the disclaimer?
Sure. Any advice contained in today's presentation is general only, doesn't take into consideration your personal circumstances. You need to decide for yourself whether it's appropriate for you. Past returns are not an accurate indicator of future returns, and I think it's fair to say options are risky. And if you didn't realise that, well, you would have got a good reminder of the last couple of weeks. But we always do say that up front. And if you want to get into options trading, be aware of the risks, do the work. Otherwise, don't do it. Basically, yeah.
Yeah, I mean, a complete sidetrack, but the guys that promise 80% returns typically the ones that do the high risk trades. So that's where it's important. Options can be safer than equities, can be.
Yeah.
You just need to know what you're doing.
Yeah.
So anyway, so that's cool. Leaderboard. So we sent out a leaderboard, and we found some discrepancies in the first 4 results, which means that the game winner from the real public that won last game has won again. So Moon Patel has managed to win again. Last game he ended up breaking the record. We thought that this record was broken in light of the market. And he ended up on a portfolio of 480,000. Last time he finished at what, 1.8 or something million?
Who wrote his name? That is not the correct.
It's speak to Tim.
All right. Well done, Moon. Anyway,
he works in your office, mate. You know.
Moon did a wonderful job last game as well. And sometimes what happens is we'll see anomalies in people's trading, so we run a line through it. But Moon's legitimately got his account up for another big win. Got to talk to him about giving him a job. He's killing it.
Has his profile been published on the ASX yet?
They mentioned today that they were publishing it. I think they were going to put it in the newsletter.
Yeah. Oh, cool. Cool.
Yeah.
That's the thing. You in the game, you would be in the newsletter. Was it 200,000 people or something?
Yep.
Anyway, so this time around, a lot of puts. So typically, and this is sort of the thing that we're trying to challenge ourselves about, but typically the people that win the game win it by trading lots of long calls and long puts. So they buy a call and a put, they take a directional view on the market, and they win because they have the leverage. And if they lose, they lose, and then sort of no harm done. Moon has just been fantastic at picking direction, both games in a row. Now, we typically don't trade that way just because what we like to do is we don't try and have a view on the market because we see it as a distraction ultimately. But typically in the game, whoever takes this kind of ballsy position will tend to do the best.
Well, Tim, who manages the desk in our office, has come first and third in the game, and he trades in a very similar way to that in terms of picking direction constantly. But Moon
also
has gone
very defensive about writing his name. That's his username, man.
Okay, so Moon Patel is his username. Okay, you're forgiven, Tim.
We'll see.
Um,
We'll see.
but the previous game, Moon was cleared 1.6 million and got as high as 2.2. It was obviously trading very aggressively. So yeah.
Mm. So a long put typically will go on and make money when or a long put assumes that the market's going to go down. A long call assumes that the market's going to go up. And interestingly enough, I was looking at a strategy for a bounce, and one of the dangerous things about doing a long call option is if the market's dropped off so much, volatility is expensive, which means the option is going to be expensive. Whereas in a long put, typically you're generally looking at it as sort of as a protection against the market falling. It's like an insurance policy, but also it can make money when the market's falling. And so the typical risk reward is effectively unlimited. I mean, it's limited to the fact that the stock may go to zero, which can happen, but unlikely. And the maximum loss is going to be how much you actually paid for the option. So this is sort of the very high level view of where he was entering the market. So he bought some puts on the 24th and ended up turning a 14K into 127. That's just down here. Oop. I have a very sensitive mouse today. 14,000 to 127. Then he ended up using all of that bank to go in again, and ended up going and adding on the 27th a March 66.25 put, and then ultimately sold that back down at 471. So massive returns, mostly because the market's been quite active. That's 4 days of trading. Very impressive picking of direction yet again. So congratulations to Moon. Second player is Ryan from Queensland, did really well. He actually finished sixth ultimately, if you include the first four, but traded quite actively. And the reason why I was interested in looking at his portfolio, because he did what's called a bear call spread. Now, a bear call spread is actually quite a typical trade that we like to do. And it's in this case, it's a bearish trade. You expect volatility to come off. And in this case, he was trading an out-of-the-money bear call spread. So what he was expecting to do is the market was going to continue going down, and he sold a spread, collected all of the premium from that, which is a net credit, your maximum profit. And then if the market falls, you'll get to keep all of that. And if the market goes up, your maximum loss is the difference between the strikes less what you've received. So very interesting tip, very interesting trade. Typically a lot of long calls and long puts coming back. I like seeing a lot of the players that come back for the second, third time in the game have been trading more advanced strategies. We ran a meetup in Melbourne and Sydney. I had my own coronavirus on Monday for the Melbourne event, so I didn't make it. But in Sydney, there's a couple of people that came through the game mentioned that they've been playing for the third or fourth time and they've been trying different strategies, which is great to see. So instead of just trying to go on and win the game, the people that tended to get the most out of it were the people that started trading a little bit outside of the box. And this market is perfect for that. We run a trade group for our clients, as I mentioned at the start, every Thursday at lunchtime. One of the themes we've been talking about is a long straddle, and you love a long straddle. So do you want to talk about the infamous straddle?
Yeah, sure. So I mean, look, a long straddle is just a trade that there are certain periods of time where I like to trade, and a period like right now, I probably won't be looking at a long straddle until I see a level forming on volatility where I can understand the range on it. But one of the reasons I really like it is that if I'm picking direction, I don't mind having a view and picking direction, but I'd really enjoy picking direction on volatility, right? And
Sorry, just quickly, a couple of questions came up going, why exactly did the others not win? Ultimately, there was a bug in the system around trading after the XJ options expired. Technically, the market was still kind of moving, but the options expire as at the OPEC price in the morning. So effectively, the opening auction of the XJO. A couple of people actually traded, there's a lot of the first couple of four, they actually traded quite legitimately. The only problem is the big wins occurred after they actually would have not been able to trade in the real market. As a result, we've ultimately had to disqualify because it wasn't reflective of the real market. So we're, to be fair, was something that we fixed about 3 years ago, or maybe 2.5 years ago. Not sure why it sort of came back, but they found the anomaly and that allowed them to drive up. They leveraged up their account and ultimately drove their profitability. So thus, we had to disqualify.
Yep. Okay. And if anyone is in that mix, just take it up with Ivan directly. Yeah.
Thanks.
So anyway, so how difficult did we say the long straddle was? There you go, 10%. Jeez. So basically what we're doing is we're buying a call and a put at the same time.
You never trade anything more than 10% difficulty.
I was saying, gee, 10%, that's high for me. Basically you're buying a call option and a put option at the same time. And if you look at the little image over here, you can see that on expiry, you want it to be, you're making money if it's gone up or it's gone down enough, right? So what I want to do is buy something where the volatility is low, and I can trade that volatility if I want to. So my max profit's unlimited if I'm depending on. Unfortunately for me, it was limited when the recent pullback. I've been known to get out of a trade and not see the full run through on the market, but that is also sort of part of the trading strategy that I deploy. And that max loss is the premium paid. So you've got big upside. And if you manage and get in at the right points on volatility, you should, it is one that you can really sort of, you're trading against the clock ultimately. So it's good when you don't know where the stock will go, but you expect it to move a lot. And it's also good if volatility is at lower levels and you expect volatility is going to move, and you can benefit from both those
Typically,
scenarios.
where you put them on was around pivot points. So where the market was at 52-week highs, it was breaking up, or it was around there, and you expected that, well, it is going to continue going up or it's going to continue going down.
That's correct.
So
ultimately, I try and set the trade at a level where if it's breaking up to a level, so even if it breaks up, volatility is not likely to fall too much because it's going into sort of uncharted territory. And at some point in time over the next, say, 8 days, I'm wanting to see, I think there's a good chance that volatility will go up 20 to 40%, and that there will be a move on the upside of 80 points plus, or on the downside of 80 points
1,200
plus.
points minimum. Yeah. That's you don't trade a straddle unless you think the market's going to move 1,200 points.
Well, therein lies the difference between you and me, Ivan. But you've made a lot more money out of trading than I have, so that's all right.
Yeah, not the last 6 months. Yeah. No, unfortunately, it's interesting. So I made the call on a Thursday, Webby. I even got your approval to go on and put it on because it's a staff trade, and I never got around to doing it because I've been so busy with work. But the trade was good, so we called it. You ended up putting on a straddle. You didn't hold for quite as long as you should have, but I think you ended up doing about a 4 or 5 in the last month and a half. Ended up being profitable in every single one of them.
Yep.
I mean, you did pick the timings well. My modification was what's called a strip, which is ultimately takes a straddle, but instead of buying one put, you buy 2 puts. So you've got a slightly more bearish recollection, which makes it just slightly more difficult. Because, just to show you that.
You've modified these slides. Come on.
Not at all. But that's the way we called it. And the basis of that was that we saw that at that point in time we were talking about asymmetric risk. And I mean, for anyone who's interested, we can probably bring up the recording of it. But we were talking about asymmetric risk, and you've got some friends that own some hotels, some crayfish farms and whatever else. And we started to see, even though the market was breaking through to the highs, and volatility was sitting around about 10%, which is why we really wanted to get onto this long vol trade.
It wasn't making a hell of a lot of sense.
It just was, so broken. And so we thought, okay, well, there's a chance that ultimately the market's going to continue going up and grinding higher and ignoring fundamentals, or something's going to break. Now, full disclosure, we didn't expect it to kind of do this. But the basis of the trade was quite simple. It's a 28-day trade at that point in time. In my typical trading, in my trading generally, what you ended up doing is the first day when a market really sells off, it always goes and does a second day, or pretty much all the time that I've experienced. Not backtest the data, but every time I've experienced, you ended up if the market closes on its ass effectively right on the low, it'll follow more often than not, and and so the idea was you have the 2 days of losses, so you sell on the close. So in other words, you end up selling one of the puts there, and you effectively have an in-the-money straddle at that point in time. The rest of the strategy is a free trade ultimately, and you hold it for 14 days.
Yep.
So it's half of the life of the option, so 28-day option. You sell it at 14 because after that the time decay starts kicking in, and you just don't want to be there. So you ended up closing it there. So it was a great call. I'm kicking myself that I never got around to doing it. Although I probably did a couple of things that will end up making me more money than that longer term, but it was annoying. The end result of that was we were looking at putting on a $5,000 risk trade because of the nature of the trade, because I was looking at closing it after 14 days. The maximum risk I had to put up 11 grand or pay 11 grand for the trade, although I would have sold it even if it didn't go anywhere after 14 days.
So your time decay.
My time decay, before the time decay really started kicking in, so it was about 50% off.
Yep.
So the real risk was 5 grand. Net return there of that trade, we chucked into the back test, was 82 grand. So really annoyed that I didn't do it. But having said that, if you go through our last 3 or 4 months of the next big trade, there's been a consistent amount of good trades. Ultimately, one of the guys on the line presented with us in Sydney. One of our clients, Brian, who's on the line, he got us into the straddles in the first place, which the reason why we started looking at them was an earnings crush trade. And that's how we sort of went, actually, hang on, this is a good time for straddles, and start hitting straddles. So that's sort of how that whole thing started. I've traded a bunch of strips in the past because I'm always a little bit bearishly biased.
Yeah, and look, I used to do this trade, but I did it as a credit years ago using my share portfolio, so I could, and it used to be something that I did all the time, and in higher volatility markets. So there's no reason why you can't get back into this type of style of trading, but you're going to want to know that volatility is going to be, at a level where you can understand the range of it before you venture into it, because the enemy to the trade is volatility coming off. Yeah, and yes, it's going sideways, but it's more the volatility coming out of the trade that will hurt you. If you're trading with like you said, 14 days was what you're giving yourself, and I usually give myself 10. A bit more conservative, but also hurry out of there a little bit more than you do. But
yeah. So some interesting things. So, so David just mentioned, well, ScoMo announces his stimulus package. Is the market going to pop up 10%, or is the market going to continue going down until the vaccine is invented? And, and ultimately this will be the turning point for the market all over the world to pick up. And bulls at, sort of GFC times. Interesting things to, overall, we typically ignore fundamentals. They have been completely misguiding traders for about 2 years, maybe 3 years. With global trade wars, which we don't even remember last time we mentioned trade wars in the newspaper, which is still going on, by the way, right? And we probably this whole situation with it's probably leading towards people pushing further towards closed borders. But yes, tourism, hospitality, there's so many industries that are impacted directly by this stuff. But having said that, well, really, what's the impact going to be? Well, how much is the market priced in? The market is very reactionary. It didn't care when coronavirus kicked and the market was breaking all-time highs, and then we cared suddenly when toilet paper disappeared. Like, there's facial tissues now, by the way.
I don't know, and I know a lot of people are sort of wondering, are we at a level, and those types of questions, and I think my comment last week was, if you try and pick bottoms, you get a smelly finger, and I've
never heard you say that. Brilliant.
But is
that copyright?
That's copyright, yeah. But I think for me, we're kind of at a we'll see stimulus, we'll see liquidity walls going up. It's not in anyone's interest to let it just keep going, but that doesn't mean that the longer term issues are going to go away. I'm just saying that I don't know whether this is the moment that we enter into a bear market and go continue that move down. I do think that moment's not is closer than it is far away. So guards are up. But I just as from a trader, not from someone who's an investor, from a trader, I think that there's going to be trading opportunities on the up and the downside, but I'm not just going all in short just yet.
I think the big test is going to come whenever this bounce happens, and today possibly was it was very bottoming type scenario where the futures were pointing to 350 down or whatever it was. Ended up closing 179 up, and I think that those kind of moves typically signify that suddenly the sellers are a little bit exhausted. What's going to happen is there's going to be a pop. I think I was talking about this the other day. There's going to be a 400-500 point rise. This morning I think we were talking about this before the whole thing started. I think there's 400-500 points in this, and then as soon as it happens, then what happens then is going to be the big thing. So over the course of the
we
bull
were
run,
trading this morning, and the market was off 450, and US was off, and as we were watching the market come to open, we had some positions to make some moves on, and we saw Wall Street up 500, 600, 700 points. Aussie market started to get a move on. Then we were up, and then we were down, and on
and
close,
then very up. Yeah.
we were very up.
It's just going to be so. We'll get this, and it's probably more of a Thursday conversation than anything else before we get completely derailed. But seeing what will happen, that'll be the sign. So typically during the GFC, what happened, or any bear market, you get these dead cat bounces, and they just get smashed down. So anyway, we probably should move on before we bore everyone with our market talk. Anyway. Iron condors have been coming up a lot. We love an iron condor because it's sort of the reverse of a straddle. That's sort of the things that you look at trading now, and when the market is when vol's so high, you effectively want to be a seller of volatility. Volatility tends to be a mean reverting instrument more often than not, which is why professional traders love it. We make money in sideways market. The typical idea is that volatility drops off. The higher the volatility, the more irrational people are about unexpected moves. And so what we expect is that the risk of a move in either direction is high. And we've been talking about this for how long we've been running webcasts together? 3 years, 2.5 years. This is sort of the thing. And it comes back to this Charles Dow theory, the guy who started, the co-founder of Dow Jones, the guy who started Wall Street Journal. He used to write about this all the time. And the basis of it is that there's this kind of move between greed and fear, and it's funny watching the slide now is so much more relevant than it was sort of 6 months ago when we put it together.
Do you reckon he's smiling underneath that beard?
I don't know. I don't know. I had one of those until Monday, and then I actually decided to shave. But anyway, and so we went through this, and I remember I think not so long ago we're talking about, we're probably talking about this period of heightened greed, where you feel, the general public feels bulletproof. And what he was been writing about as sort of the first real sign of technical analysis is that we are the most convicted about, most enthusiastic about the move continuing higher, which is right about the time when we have this heightened sense of greed. And then ultimately we go down into this period of hope and disbelief, and then we continue throwing in the towel, and then really becoming fearful. And we sort of get to this shock and fear apprehension moment, and then ultimately we surrender, and that tends to be the low of the cycle. And one thing that I noticed on Monday, and I've got a fair bit of data that I look at throughout the market, and up until the point of Monday, we were really in this period where it was just an orderly exit, and it's somewhere in that stage where, but what ultimately happened is on Monday, we flicked over from that element of just hope where it just started getting into an element of fear. And that was interesting. It's the first time I've really seen this in this market for, I reckon, 10 years or so. Well, since really GFC, so 2008, 12 years. When volatility is high, like right now, it's usually during periods of extremely heightened fear. And then when it's low, it's these periods of greed. So we were consistently low volatility. We were really starting to show signs of greed. And the basic example is if there's a stock and everybody wants to go in and transact on the stock, half the people on the side might want to go in and buy that stock, half of the sellers in the stock might want to sell that stock, and we're all happy. We're happy at the price. We just transact. What happens if suddenly there's some elements of uncertainty coming in? The sellers start pushing down their offers and they want to sell at any price at all. And the buyers suddenly realize that they don't really want to buy at these prices, so they just wait. And that starts shifting the scales. And that's ultimately where emotion comes in. That's ultimately where fear and surrender start coming in. And you'll notice that every time that implied volatility is high, this is an example of CBA back in 2018-19. Just on the back of the Royal Commission, it's really started falling off. It started coming back here, and every single time volatility started spiking above that 20% range was ultimately led with a bounce. And I think it's really interesting that we're now in this period as well where everyone is so uncertain about what's going to happen, but ultimately we're at that period where volatility is extremely high. Sure, you've got to protect your positions, but if you're thinking about, again, asymmetric risk, you've got to think there's a bounce in here somewhere ultimately, just on the sense that everyone's fearful, everyone's uncertain, and that's where we're at. So what we did is we gave a bunch of this data of implied volatility just to see how accurate it is to our quants. And they ran a 9-month research project, and they ultimately tried to look at directionally neutral strategies altogether. And ultimately, they proved the accuracy of this data and quite how important it is when it comes to predicting short-term moves. There's actually a lot of value. We probably should now extend it since it's been ultimately a year since we've done this. But over the 3-year period, a bit over 3 years, we found that ultimately, I'm not going to bore anybody with statistics, but a 1 standard deviation move ultimately means a 68% chance, as what we know from all the statistical study that we've done. Implied volatility was correct 70.5% of the time. 2 standard deviation move happens 95.3% instead of 95, and the fat tail is a little bit less than what people expect, 99%. So if you have the very simple, what is implied volatility, what is 1 standard deviation, if CBA has an implied volatility of 15%, that ultimately means a 1 standard deviation move is 15% over a year. So you put it into a crazy formula, and then with square roots and 365s in it, and then ultimately you get the vol over a period of time. So an iron condor is a harder trade because you do have risks around assignments and exercises and that kind of stuff, or ultimately assignments. But you expect volatility to dry off. And the further the time decays, the more money you will ultimately keep out of the trading strategy that you've got in place. And so you buy a deep out of the money put, you sell an out of the money put, and then you sell an out of the money call, and you buy deep out of the money call. The thing I like about this is inside the strategy, it's got its inherent stop losses. So even if the market drops 15% overnight or goes up 20% or whatever, you're going to lose the maximum loss. You're not going to lose more than what you've initially set out to lose. If you go into our platform, it's just as simple. You just type in iron, and then iron condor comes up. You just click it. Yeah, brings it up.
And so if you're someone that's already requested the trial, the 30-day trial, which will give you access to everything, we'll give you the Iron Condor trade ideas as well.
Yep.
And we'll give you access to the cookbook where you can select those very easily. So type in Y, the letter Y will do. I would have typed in the word "why" like a couple of people did. So I was like,
Kevin,
yeah, I was feeling.
That's what I was like. What? Why? Why do you anyway?
Yeah. No, I would have typed "Y" for sure. The letter Y or Y, either or, and we'll give you a 30-day trial.
Yeah. The way it'll work is ultimately you think that the market's going to stay around 6,000 points. It's funny, the market's now lower than 6,000. Last time I did this was about 7,200. But anyway, you sell a 6150 call, sell a 5850 put. You've got the 6200, 5800 protection. Anything between that 6150 and 5850 will give you maximum profit. Anything above 6200 is maximum loss. Below 5800, maximum loss. So anything in that blue range is good. And then we ultimately, in this case, bumped right up to that 6150, came right off, ended up at 6,000. That's your maximum profit.
Yeah.
Really simple to visualize, really simple to understand. When you click the iron condor on the button, it actually calculates the deviations for you, creates effectively like a 30 delta spread. So it does all of that hard work, the statistical side there, half standard deviation each side is sort of what it does.
And it's a trading strategy that works really well when something actually sells off. And now, not necessarily what we're seeing at the moment on the XGAO, but you'll certainly see this on plenty of stocks, is that we'll start to see dispersion on how things are running. So some companies will sell off, they'll consolidate at these levels. So you've got these massive high volatility, but you expect the share price to consolidate. This is where this is an amazing strategy. And you get both sides of time decay on the position.
And typically what happens is during a move like this, I mean, it's a proper fat tail event. We've had a couple of bad trades right on the end, but that always leads into, we'll have probably 10, 12 trade ideas this month. And of them, you'd probably think about 80% will be fine. It's just I was just people in the background. Who's even in the city at this point in time, aside from people that
we're on television? I don't know what you're talking about.
Work all day.
All right. Continue.
Thank God we're in the injury room. Anyway, so volatility coin. So we typically play in that space. One thing that we found from all the analysis is that instead of kind of trading traditional iron condors or everyone else trades, there's actually a statistical edge in terms of bringing the strikes in, and so just really pricing up the most the kind of the cream of the crop trades that really meet all of the different indicators. High volatility, high IV rank, significant moves away from its 52-week moves from the moving averages, and typically stocks that are really showing signs of consolidating. So this is ultimately what we chuck into our quant ideas, and we break it down into 3 different cycles. The option game players don't get this because it's a bit unfair. But the scale is ultimately gold 80 points plus, silver 75 to 80 points, and bronze 70 to 75 points. Typically, these translate to over a backtest period of about 4 years in terms of roughly the coincidence of them actually being correct. We look at a whole heap of different stuff. Up until Jan 2019, before we launched this, that's sort of where we were sitting, including the brokerage, which is implied volatility. Brokerage, obviously, past performance not an indication of future returns. We had 5 gold trades that popped up, 80% win rate, 28 silver trades, 71% win rate, 93 bronze trades. Ultimately, the big difference is that if you did every single iron condor completely at all points in time, you ended up losing approximately $200 per trade, which is the brokerage ultimately. And what we showed is we filtered out the sort of the 54% of trades, that 54% of losers, I guess. 48%, and just sorted them into buckets. So you can trade as much or as little as you want. Ultimately, based on different accounts, 10, 20, 40, 100%, 1,000 accounts. If you're doing just the gold trades, you get periods of sideways movement and then just really high profitability. I think this is probably a time when we're going to get a lot of gold alerts, and they're really that's really sort of when they cream it. But if you trade silver, bronze, and gold, you actually get a lot of these bronze trades that really give you a much more consistent growth, which is also interesting. Since April 2019, so this is updated data. So since we launched this service, these are the trades that have come up. These are the confidence rates, so a lot of these sort of 70s, sub 80s. We've had 2 trades there in around. We had Feb was difficult for obvious reasons up until then. So that's sort of what I was talking about. That's sort of the last movements. A lot of maximum profits. We came off SEP to really the Feb expiry has been awesome. And now that the market is really here, this is prime territory
I
for
think
iron condors.
probably really important. The way that we trade iron condors, it's not like you need to trade across a sample of 10. Because if your sample is, you don't mind if there's a couple of small losses in there, but you can see, geez, if I had 200% losses and I was putting in 20, 30% of my bank on any one trade and that kind of stuff, you really want to make sure that you're in a position where you're not doing a massive percentage of your bank on any one trade. Is that correct, Ivan?
Correct. Yeah, exactly.
So
we pick them. We sort of had two ways of doing it. One was being right 80, 90% of the time.
Which is the most popular way of trading this type of strategy, but not the most profitable.
Exactly, yeah. So we saw significant bump in increase if we were down at around about 60, 70%. And this, I think now, I mean, if you exclude February, we're significantly over sort of 75%, right? If not higher. But including Feb, we're still at 67, I think I looked at it, percent right.
Which is about where our longer term average sits.
Yeah, exactly. Yeah. So, and after the Feb expiry, after the March expiry, we've got a bunch of trades now popping up, a lot of gold trades coming up. So it's and it's a good time to be trading vol. Anyways,
it is a brilliant time to be trading vol. Vol has not been something we could trade. So as much as I love to trade a straddle in low vol environment, an iron condor in high vol environment, definitely.
Exactly. So the way it pops up in the system, it's actually this is sort of the traditional dashboard, but you get the ideas. It shows you the points. We get the market maker pricing. It shows you the max reward, max risk. You can ultimately slide it up and down, and then get to place a trade. Some of the pricing sometimes doesn't work in the less liquid stocks, and we can throw them out. We get market makers to go on and provide liquidity on those days. Right now, ultimately, it's a pretty cool time. You can go on and edit the strikes if you're not happy with the strikes. You can go on and do that. You get all the views, so you get 20. In this case, BHP is $26, break-even is 24 and 28. The maximum profit means that the stock needs to end up between 25 and 27. So very clear visually where you need the stock to end. You can look at the chart, place trade, and then ultimately you've got it in there. Trading systems.
Yeah.
Why are they important?
Well,
talk about lit.
Trading systems. When we think about how we trade, we approach it with a trading system, and it's effectively a business plan for one particular style of trading that you're approaching, or it could be your overall style of trading. And so when I think about trading a straddle, or Ivan's talking about trading a strip, we want to consider everything that's going to help us be successful over a period of time. We understand that every trade we do, or even for a period of time, our trading might not work for us, but we go in there with the confidence that we know if we follow our system, that we're going to make money eventually. And it's the same as if you opened a shop and you were, I always use the bakery example. I don't know why, but if you opened a bakery
Have you ever made bread?
No. Once. At school.
Was it good?
It was delicious.
Is that what your mum said?
When you open that up, if you just think about how good you are at making bread, i.e. picking direction or understanding options trading strategies, and you're just focused on bread, well, what's your service like? What's your recruitment? Did you open on the right side of the street, or did you open on the right street, or whatever the other things that need to be considered? A trading system is your way of thinking through the things that will allow you to be successful. So one of the iron condors is a trading system that we have, and that allows us to trade when the market's going sideways. And the lit is a strategy or a trading system that allows us to trade directional moves. So breakouts on the way up, breakouts on the way down.
And that's the one that ultimately smashed it this time. That's the consistency that we've seen. The leading indicator trend trading system. So, but yeah, there's sort of a whole bunch of reasons why you want to be trading more mechanically. I think we probably should just.
Well, a lot of people when they're trading, they're looking the one thing they're looking for is they're looking to find the bullish trades. Like we're all sort of have a predisposition to being optimistic and understanding something performing well and identifying value and all those sorts of things. So we want bullish trades. But if you're trying to find bullish trades in a bearish market or in a sideways market or in a low vol market, whatever it might be, you know, if they're not there, you're still going to find them because that's what you do, right? The old saying is, if the only tool you've got is a hammer, everything starts to look like a nail. With trading systems, you want to make sure that you've got strategies that allow you just to observe the market and give you the best opportunity to identify or trade it.
For your birthday in December, I'm going to get your sayings book.
Get
and
some
analogy.
fresh saying.
Get some fresh saying.
I actually bought the little brown book of analogies the other day.
Oh, good.
And you know what? The book was green. It was a green book. Anyway, it's anyway. I started reading it. Haven't picked up anything there yet for you. Anyway, so the flow of a trading system is in this instance is pick direction, pick entry, monitor position, then have a checklist in place. It makes what I'm doing as mechanical as possible, so that when I'm in my trade and the market falls, when I get into my straddle and the market falls 150 points the next day and volatility goes up by 50%, that my trading system tells me what I should do next, not the emotions that are coursing through my body at that point in time.
Which
and that
may have happened with you.
Well, no, they weren't. I was just in a meeting trying to clear my decks, but it's still a good trade.
Okay.
So
well,
anyway,
it's better than my trade.
Trading without a system is like starting a business without a business plan, and the things that we look at, and we want to trade mechanically, reduce emotion, risk management focused. We're talking to universities at the moment. We're just going through the final stages of getting approval on a grant to bring in 4 PhDs or one three and one doctorate.
3 postdoctorate, yeah.
Yeah, and to help us and really just help traders in general, and we'll be part of the process and facilitate it to be able to get better information to bring into what they're doing so that they can just be more mechanical about their decision making. And humans are terrible at analyzing data. And so we generally arrive at conclusions based on, think about how you operate and, how you think about yourself, or the judgments that you make, which are based on such small amounts of data. And we do the same when we trade. And trading is emotional sort of process. So we want to remove as much of that as possible. So quant architect, using as much data as possible to increase our odds of picking direction, is definitely a big part of what we do. All right. So in thinking about a trading system, you come up with a hypothesis. So some of the hypotheses that trading hypotheses that we've called, we probably haven't referred to them when we've been discussing it, but have been over a glass of red wine or 5.
Sort of slurring the hypotheses.
But it's come to these are a robust debate over what how we've traded and what we've observed. That's how some of the things we've looked at, which is probably goes against the grain of some of the things we've just mentioned about being data focused. But then at that point in time, we would test that, then define the rules, and then optimize these rules. And that's what we've done with the lit trading system. So rather than go out there, we actually went and did a lot of analysis. All right. So let me step through this. And anyway, we've gone through this, and we're going to be running other sessions over the next week or so. We will go through some of the lit rules, some of the other rules, and teach them in more detail. But if you want to get access to the platform where a lot of this stuff is recorded, and get access to the trading systems and scanning tools and trade ideas, suggestions, type in yes. And we'll sort that out for you. But I might just sort of skip through this.
Thursday Webbies.
Yeah.
You should probably run through this, because I actually talk about the game, the trade, the one that's been consistent throughout all this.
Okay.
So
okay. So
very 2-second
breakout trade for us. Okay. So it can be a breakout on the upside and the downside.
I'm just going to preempt this. So the trade that actually would have won the game, if we were allowed to trade, based on the trading system that's done this, was actually a bullish trade.
Yeah.
Take it away.
Okay, so I don't know what trade it was.
It was a lit long.
Yeah.
Lit long.
Yep. XGO. Yep. I'm going to guess it was a repair, but there is the.
However, did you guess that?
Yeah. Well, is the share price above major resistance? So the thing we look for is a 52-week high. So on this particular chart where you see the arrow in the middle, let me get my mouse over here, it had just broken through a 52-week high, right? That's a major level for us. We want to know at that point in time that the 50-day moving average is above the 200-day moving average, and we can see that's the case. Is the share price above the 50-day moving average? Clearly that is the case. Is the 50-day moving average trending up? And it is. And we want a confirmation that there's some legitimacy to this, or there is some momentum to this move. And so the question we ask ourselves is, where's the ADX? And we want to know it's above 20, right? And so if all of those things line up, we really don't think too much. There's a couple of things we might look at, but basically we then go into a strategy called lit long, which is for those of you that are experienced options traders and at the money bull put spread. All right. And we stay in that trade until we either see we make our max profit, or if we see the share price trade below the 50-day moving average, then we will switch the trade into we will buy back the sold leg of the strategy, so the sold put, and we'll be in a straight put, and we'll switch that into a bearish position. And we'll either ride it down or based on the rules, we might re-enter into our bullish position. But really what we're trying to do with this particular strategy is trade off a significant pivot point. When the move breaks, we expect the odds are in the favor of the move continuing if they meet all our rules, right? So we statistically can prove that the majority of the time this will continue on a run, and it won't be a small run, it'll be a significant run. And we set the trade up where the time decay works in our favor as well to get the move in the right direction, and off we go. And we don't go into them trying to make 20%, 30% profits. We go into it where we expect there to be a significant move. We sit in the trade for a period of time. So we're not sort of trading the sort of swing small moves. Now, the biggest profits we've ever made with this particular strategy have been where we've got it completely wrong. And we expect to get it wrong when we do this trade. So we're expecting it there to be a shift. What we're expecting off the pivot point, the thing that we've got the most amount of confidence is that that on the upside, the breakout percentage-wise, we're expecting that we'll get that right a lot of the time. But when we don't get it right, we get it completely wrong, and it's a fake out, and it moves down. Probably this picture of the chart where we got into that trade, and where the following day there was that significant move down. That is an example of what happens when that 52-week high fails. All right. Yeah, so in this instance here, what was the trade? Well, I know what the trade was, but I thought it might have been a stock in there that was the winner. No, it was the exchange.
No, so I mean, just for pure consistency, since the day that we launched this trading system out to the public, we've only traded XJO. So it's always been the same in the game, yeah. So it's always been, and the basis are the same. We didn't always enter on the first day. If it's sort of sitting around a 52-week high, we wait for the 52-week high to be breached. And one day one of the games, the only game that we didn't really finish in the top three, was when we just waited too long. It's just literally the market didn't do anything. But other than that, the reason for its consistency is we've always done the same thing. 50K trade, XJO, kind of all on red or black ultimately, but with the edge of the trading system behind us. So we did the same thing. We leveraged this, so 100K max risk, 100% max risk, 50K trade, one trade, ultimately with one repair, ended up with over 556K. And as you can see, I thought
Moon Mattel got slightly better than that.
No.
Sorry,
442,000, I think, if I remember my numbers correctly. But thanks for judging it.
For doubting you.
Yeah, always same thing. And the thing here, so we only recently just moved to 4 games a year. June, December. June was when we launched. December, July, December. And then ultimately we started going to 4 games a year. So first, second, third, first, based on our last results. So again, consistent. And I don't know what the slide was. Thanks, Tim. I have no idea what that was. It's probably something from behind. Anyway, whatever. So a lit long, the trade rule is that as soon as it broke so we were really, really wrong.
Yep.
We were really offside until the market cracked through the 50-day moving average. We'd switched, and then ultimately it was just sort of as soon as the market goes below 50-day moving average, it typically goes and falls off. So risk reward, net credit received, difference between the strikes until you get it wrong, in which case it really starts shifting. So we did a 71.50 at the money. We sold a 72.75, which was in the money put, and ultimately then we ended up closing off the sold put, so we bought back that, and then just had a 71.50 bought put, which obviously smashed it since the market did what it did. I think that would have probably been the WPL was our biggest trade by that stage. So anyway, RV platform. Do you want to talk a little bit about that in a bit more detail?
Yeah.
Implied. Well, do you want me to talk about it?
No, I'll talk about it. Why don't we just go to the platform? So,
Sure.
I can remember all those things. So we'll log in. So the implied volatility trading platform, which is our trading platform, is the same tech. I mean, there are quite a few extra things that are built into the IV platform that you don't get access to in the options trading game. We're going to try and bring some of those things across, I understand. But it's designed specifically for options traders to trade the market. So,
sorry, I'm just completely going to... So this is the new dashboard that we've got for those of you that haven't seen this.
Yep.
This is how crazy the market is right now. So Flight Center today was an 84-point gold trade. Typically an iron condor, because you've got the odds in your favor, your risk reward, you're actually risking a little bit more than your reward. In this case, for every $4,000 that you'd be risking, your reward would be 5,600. That is crazy.
Yeah. I was looking because someone said to me an old funds manager was talking to me today and was talking about, BHP won't go below $65 was his comment to me. And I went and
65,
right? Sorry.
I don't think it ever traded 65.
No. Sorry. CBA.
CBA. Yeah.
CBA. And at that point in time, CBA was down from where it is now. And I just priced in a call option at $65, $1.84.
Wow.
Yeah, $1.84. Yeah. Tell you. I mean, so if he doesn't think it's going to go above that level, then why don't you write some put options, pick up $1.84? What's your break even is like at $62, whatever, right? So
and just have a bit of protection below it, and you can
also $63 something. So it's doing some amazing stuff anyway. So the platform is designed specifically for options traders, gives you all the tools that you would want as an options trader. It gives you the most powerful calculators. I might just drive for a second, Ivan. The charting is award-winning charting. It's the latest and greatest.
I've got a new podcast starting end of the month, and I've got the CEO of Chart IQ from US coming in.
Yep.
So maybe you can come around and meet him.
Yeah, cool. Excellent. The options cookbook.
I only had to confirm.
So we can, any options strategy, you want to go in there really quickly. Let's say, for example, you said, I wouldn't mind doing one of those iron condors you were talking about before. Just type in iron and select it. Okay. I might go, let's say 37-day expiry. And off we go. And I've got an XJ iron condor priced up. If I wanted to trade it, I go execute strategy. And we can't trade now because the market's closed. But it'll price that up all the way through to you being able to put that trade straight into the market. Now, if you were anyone else wanting to do that trade, you'd pick up the phone, you'd speak to your broker. And I was looking at a broker's website today, and it was quite reasonably priced for a full service broker. And they charged $100 or 1% of the premium to do that trade, $100 or 1% of the premium. So there are 4 legs to that trade that would cost you at minimum $400, but the 1% would probably kick in on the premium, if depending on what risk you were taking. And so it's sort of to get in and to get out $800, right? Which is could be where your profit is on your trading if you trade like that over a period of time. With us, you can trade that online. So we're the only place where you can click on that execute strategy and put that straight into the market with all of the valuation tools and everything around that. It's $24.95 to do that per leg. And that means that someone can go in and do that trade without having to risk 10 or 20 $1,000 just to cover the cost of their brokerage. They can do it with 1,000, 2,000, 3,000, whatever level you want. And it might mean that instead of not wanting to close it out because of the cost of I need to make more money, and then they sit in the trade longer than they want, or whatever it might be, they get compromised. They can just trade away the way they want to trade. And that, yeah.
It's 500 points each way until April for a break even. That's how expensive volatility is now.
Yeah.
That's just next level.
Yeah. But I could do it in a day, right? So
on.
Almost has.
Yeah, true.
But this is kind of I'd be looking for stock-specific iron condors at the moment, but you? No?
The 64 IV rank is a bit kind of, because it's just come off. It's probably just showing that it's not. So IV rank 0 to 100. 100 means it's super expensive.
Yeah.
Easiest way to find iron condors is to go into the IV rank sorted. And you just look at sort of something with a little bit of value. So our team's pretty cool. Flight Center we looked at. I mean, that's massive. You look at that. That's Vol's really spiked. Over 90 days. That's a crazy sell-off. That's come off. Reduce Origin back to 6. That's massive. That was that's crazy.
So you can look at that and just click on volatility at the same time. Yeah, you got that open.
Yeah,
so you can see what volatility is
doing. Look at that. That went from 30 to 60
Yeah.
from the 5th.
Yeah.
That literally vol doubled.
Yeah.
So you think that, so typically, vol corrects, should come back to about 25% for Origin. The downside is it's sort of but that's crazy.
Right. So you can play around with all of that. Some, people will say, well, which are the most liquid optionable stocks? We can go in here and just click on liquidity, and it will give you all the most liquid, starting from the top and heading down. So you can see, XJO, interesting AGL. Didn't realize it was that liquid. What else have we got? So that's an example of the sorts of things that you can play around with, but it gives you live ASX data, gives you, S&P ASX indices, options cookbook, the ability to go in, our scanners that we've built. So if you want to have a look at those lit longs that we were talking about, or lit shorts, it scans the market. It identifies when there's a 52-week low or a 52-week high, where the 52-week, and with the appropriate moving averages and so forth, and it gives you all the other information to identify those trades. If you want to do it, you just click on a button and it pre-populates the trade for you. It gives you the ability to go in and do back testing. So, if you hear us going on about a strategy, you can go, well, okay, let me go back and have a look and see whether what they say actually lines up over a long period of time, and you can back test and load any strategy you want in. So if you want access to the back testing, type in yes. You want access to the trading scans, type in yes. There's a full education portal in there. Or if you just want to move on to the best options trading tech in Australia, take a trial, continue for 30 days, and it will allow you to keep paper trading, practice trading, having a look at our trade ideas, and just getting a better feel for how it operates. What we've noticed is, we thought when we started this that a whole bunch of people would migrate over straight away. But really what people did was they played with it for like 6-12 months. A lot of experienced traders, and then a lot of the very experienced traders in the market moved across to us, which is really where our growth has come from. It hasn't come from a lot of people. It's just come from a lot of the bigger guys in the market coming over and joining us.
Well, we're about to get the biggest one, so in the market.
Yeah. Yeah. So anyway, for any of those of you that would like a trial, there were some comments and so forth made. So we might make our way through that. But if you've got any further questions, please go and just chuck them in the chat box. For every one of you that has requested a trial, we will coordinate that tomorrow. Tim will get in contact with you and get you set up. And if you've got any questions,
Also, you'll get invited to the Thursday sessions where all the big calls are made. The next big trade, Thursday lunchtime, Sydney, Melbourne time. So that's on this Thursday again. Massive session, obviously, on the back of everything that's going on. I think it's probably going to be our biggest. And I say that now, in 2 days of markets moving up, and suddenly all the trade alerts might not show up.
Yep.
But you'll get access to that. So get ahead on the trial and be invited to that.
Yeah. Beautiful. All right. I'm just going to have a quick look to see if we addressed questions.
So what do you think? What is the stimulus package going to do to the market?
What's that?
What do you reckon the stimulus package is going to do
Prop
to the
it up in
market?
the short term.
You reckon?
Yep.
But isn't it like, don't you have to go through a whole process of getting money in and all that kind of stuff? Like if they've just announced it saying, oh, we'll do this, but it's not straightforward, is it?
The US stimulus, how quickly can they move that? I don't know. I think anything like that you can hang your hat on as, okay, there might be something that's going to halt or take remedy or put more money into the market, people will get excited about. Will it work long term? Well, I'm probably a bit of a skeptic, but that's probably why I think that we could see things going up, but I don't know how sustainable all of that is. Yeah. I think it's a good time to understand derivatives, and it's a good time to be a trader. And a lot of the investments we've been working on have been hedging type investments, investing in increased dispersion or investing in increased volatility over the last 6 months has definitely been a common theme for us.
Your dispersion, you had a structured product going, and that must have absolutely killed it.
It's done quite well.
Yeah.
Very happy with it. So and we've got one going at the moment, by the way, the free plug. If anyone wants any more information about that.
Can you go short in it now?
Yeah. Well, no, dispersion will actually increase, I think, because when everything falls, that little period where it falls, it all kind of just tumbles down together. And I think what we'll see is people having a bit of a closer look. And
you know, I was catching up with the Aussie CEO and the Apex CEO for Saxo Bank this morning, and we're talking about markets and dealing where it was at. And interestingly enough, the thing that they reckon is that there's going to be a significant amount of moving towards trading away from passive again. And I mean, it makes sense. Most people haven't even seen a bear market, right? I mean, so we'll go through this situation. This may be the kickoff for a bear market, or maybe it's just a correction. Who knows? But eventually, in the near term, we will see a bear market. Something's going to kick it off. This might be the catalyst.
Yep.
And it's going to be next level different. So it'll be interesting. So I think that once you stop having everybody buying the same ETF, you know, that's where dispersion comes from.
I think, you know, I'm super skeptical on the market at the moment from the perspective of the news dictating what's going to happen next. And it's been dictating everything's going to go down and that fear's come in. A lot of value has been handed back, but I don't know that this is the point, but it's coming. Yeah.
I think we've got to wrap up. It's been an hour 20, which is typically
thank you. Well,
about 40 minutes longer than
in there. If you haven't already requested, you want access to the trade ideas or any of those other things, type in the Y. We'll coordinate to get you that. And otherwise, we really appreciate you participating in the game, attending the session tonight. Come along to the next big trade, which will be that session's on Thursday. And we'll have more educational webcasts coming up. There'll be another, we spoke to the ASX today. There'll be some more games being played. When's the next one?
End of April, May.
Yep.
Yeah. So you can go and play in implied volatility, see if you're starting to like it, and then.
Yep. So if you and if you want to just keep going, I guess until there, you know, the easiest thing to do would take a trial.
And a heap of, you know what I like? A heap of our clients play, and they generally outperform, which is good.
Yeah.
So it's good. Yeah. Anyway.
Beautiful. All right, guys. Thank you very much. Thanks, Ivan.
Thank you.